Hey everyone, we are live. Welcome to the Money Level Show where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. And so today we got quite a bit to get into in this late night live, depending on where you're watching. I mean, I have some viewers who are all around the world where it may be daytime. Where I'm at, it is 11 p.m. at night. But we're going to get into these topics because now I have time to talk about them. So I'm going to go ahead and kick the intro real quick. I hope that you all are doing well. And let's get to this intro and then let's get into the topics we came to talk about today.
Think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back. If this is your first time viewing the channel, please click the like button and the subscribe button. I showed you all my analytics before. Many people that are watching my videos are not subscribing. I mean, I think the majority of people that have watched my videos over time have not subscribed. So, I want to continue to provide this free content to everyone. So be sure to hit the subscribe button because it really helps out the channel. It really helps out what I'm doing with providing education to many people around the world on these complex financial topics. And so I want to thank you all for doing that. And if you are watching, be sure to drop a comment in the comment section below so that we can chat, so that we can actually engage with one another. It's like human beings. We are not AI robots. Let's engage with one another. So be sure to drop a comment in the comment section. We'd love to chat it up. So we got a few things to get into today. Today we're going to talk through CPI inflation. We're going to talk about what does this mean for the government and the Fed, and then we're going to get into some stock picks that I have for you all. And I want to show you all. I had some questions on the last live of why am I bullish on energy, or is this the only sector that I really focus on? And I want to show you all why. Because there's a lot of opportunity here. And I think that we're just in for a massive run, massive bull run in energy stocks. And we want to be positioned where people aren't looking, where people are actually hating the assets and, things of that nature. So we're going to get into more of that. So I'm going to go ahead and share screen. We're going to get into these tabs that I have up. So first thing, many of you that are in tune with financial media know that the CPI did rise 0.6% in August. Gasoline and shelter is up, as you can see. So it rose 3.7% over the last 12 months. So what does this mean? This means that the Fed has hiked rates to reduce demand, but the Fed cannot control supply. The Fed cannot print oil. They cannot print resources. Right? There's even talks of a diesel shortage. And diesel. A lot of diesel affects a lot of the goods that we buy, such as food and things of that nature, because it has to be transported, right? But the Fed cannot print the supply that we need. They can only raise interest rates to cause more hurt and pain, and then the cost of capital is higher to borrow, right? And so that's all they can do. They cannot print the resources we need. So that's why I'm bullish on resources, but that's also why we're experiencing an uptick in CPI. So let's go ahead and get over to the next chart. So first of all, we want to look at um, the government debt. I mean, it's continuously rising. It's almost up to 35 trillion. As you can see, prior to 2000, we had less than 5 trillion. We've ran up 30 trillion in 23 years. So this is very concerning. But the higher the debt goes, the more interest we have to pay on the debt. And so I'm going to show you what that looks like here in a second. So over here, you can see the federal funds rate. So when the Fed raises rates, the cost to the government is higher, right? So whenever the government is borrowing down here, when rates are this low, then the cost for them to finance a lot of different things, Social Security, all these different entitlements, military things of the nature. Whenever the government does that, then and they're borrowing at those levels, then the cost of capital is cheap. But now the Fed has raised rates until, to above 5%. So now it costs more for the government to borrow, and people that have bought short-term treasury bills, for example, they're buying them at over 5%. So the government's having to pay people back a higher percentage than they were when interest rates were at zero. So that's what we're seeing here now, right? Um, and inflation plays into this because the Fed is still says that it's still committed to fighting inflation, and they have hinted at some further rate hikes. So these interest rates can go up even further. And so if the interest rate goes up even further, then obviously that's more pain in the markets. Mortgage rates go up. The cost to borrow any type of funding goes up, right? And the cost to borrow government debt goes up, right? So that's how this affects the whole system. So I just wanted to make sure that you all understand that. Um, so when you look at the government interest payments on their debt, as you can see, we're here. On the side is billions of dollars. So obviously, 100 billion and 1,000 billion is $1 trillion. So this is the interest payments. It says frequency quarterly. No, this is the annual rate. I think the annual rate. So the government's up here towards $1 trillion in interest that they have to pay on the debt. So the more that they borrow, the more interest they're going to have to pay. The further that the Fed raises interest rates, the more interest that the government is going to have to pay on the debt that it's borrowing. Because people think that this stuff is just comes out of nowhere, right? The money has to come from somewhere. Like, obviously you have a money printer and things like that. People just assume like, okay, yeah, the government just prints the money, but it doesn't technically just work that way, right? I mean, usually how it's supposed to work is that the government collects taxes and then taxpayers pay for government expenditures. And also the government sells debt, such as bonds and things like that. We've had other nations own our bonds. China's owned our bonds for a while, 30-year bonds. So where money's locked away for 30 years and then our government pays them back with interest. And other things, obviously, trade and things of that nature, that's how governments are supposed to make money. But right now we're borrowing more than we have to spend. So that's why we're at a $2 trillion budget deficit. And so for those that don't know what a budget deficit is, that means we're spending more than actually our budget is. And so I'm going to actually share this screen here. As you can see, this is the usdebtclock.org. We are quickly approaching 33 trillion in debt. And you can see the US federal budget deficit is at 1.8 trillion. So it's close to $2 trillion deficit. So we're spending $2 trillion over what we have budgeted. So that's just to give you the picture, right? So interest payments are going to continue to rise. As you can see, the interest payments on the debt has risen significantly. All right. So now I want to just share, how does this relate to, resources and things of that nature? Just like I said earlier, we've been in a commodities bear market for a long time, and the government isn't allowing. We have these plans for green energy transition and all these things, but it's going to take a huge amount of investment for there to be really for this to come to fruition. And so that's why it's a very important thing. So I'm just going to pull up another chart here. That I'm trying to find. Find this chart really quick for you all. I brought this chart up many times. All right, so let's see. Okay, yeah, it's gonna take a little minute, y'all. My bad. Bear with me. If y'all up this late, y'all just hanging out with me anyway, so we're good. All right, so I brought this chart up multiple times, and we're gonna go ahead and share this right here. So this is the um, I keep sharing this because I want you all to see the links, between how all these things play together. Growth to value. When the chart is down, that means that value stocks that are cheap, stocks that are paying dividends, stocks that are out of favor, are not very fast growing stocks. Oftentimes they're doing better during this time. When this chart is up, that means that the growth stocks, that the people that invest in like a lot of the tech stocks, a lot of the growth companies, or like people pile in and they get the growth early. They anticipate, oh, Tesla's going to put out, this type of vehicle. They're come out with a flying car. Okay, everyone piles in and then they push the stock price up and you get the growth early. And then ultimately, after time, those stocks end up leveling out and either flat or they go down. And so that's why it's important to know the growth to value ratio. So for example, in 2000, this 2000 bubble, I mean, growth stocks, I mean, all the .com stocks, all of that, right, was heavily bought into, right? And so that's why I'm bullish on, a part of the reason why I'm bullish on commodities. And so I mean, you can see like the commodity charts. So we're going to look at some stock charts here now, because you can see just the discrepancy between those. Well, not the discrepancy, but you can see how they overlay. All right, so this is a company that I invest in, Mosaic. This is not financial advice. I'm just showing you one of the companies that I invest in. They're cheap. So as you can see from the growth to value 2000, right, the chart is way up, right? People were investing in growth. I mean, you even saw it in 2020, right? Growth. Even growth came back this year, right? So now this was in 2000. Then you had a commodities bull run, during this time when value stocks are doing good. So we're going to look at some of these charts right now. So Mosaic, agriculture, commodities, they focus on potash and fertilizer, right? You can see just this huge spike up. This was in 2008. This was after, I mean, obviously in 2000, when the growth stocks were booming and everything, Mosaic was not doing anything. But then you had this huge price shock, and they went up to $153, and they've been down ever since. I mean, we had a spike up during COVID, obviously with supply chains and such, but I think these stocks are going to go up even further. We talked about the food crisis and Russia pulling out of the grain deal. Russia supplies a lot of the fertilizer to the market as well. So I mean, there's a lot of things that we have to consider with this. So, I mean, this is just one company, right? We're gonna look at another company I invest in. Again, not financial advice. Southwestern Energy. All right, Southwestern Energy. So this is another one that has been beaten up for a long time. Obviously, hang on, real quick. Let me go back to Mosaic. Mosaic is at a 5.87 PE ratio. This means that they are fairly cheap, 5.87 PE, price to earnings ratio. I mean, let's compare this to a stock like Nvidia. Nvidia is at 109.88 PE ratio, which means they're way too expensive for the value that they provide. So that's what I'm talking about. Buying things that are cheap, assets that are hated, and positioning yourself so that you can obtain a lot of wealth, right? We saw the price of Mosaic just skyrocket. Okay. All right. So now here we're back to Southwestern Energy. Southwestern Energy, $6.66, right? They supply natural gas exploration and many other things, right? Um, so you know, when the .com was booming, Southwestern Energy, they trading at $1 per share, right? And then you get this commodities bull run. Boom, they just go up, 44 bucks. I mean, and some of these stocks, like they may show like these crazy charts where they shoot straight up, but some of them diluted shares since then. But I'm not saying that happened with this one, but just FYI. But yeah, like for this commodities bull run, they just shot up, and you could have got in at $1 while everyone's buying these tech stocks. I mean, Apple went up to what? Amazon went up to what? I forgot what the price it went up to, 50 bucks or something. PE ratio is 1.34, right? And it's just beat up, right? And we're in the middle of a commodities bull run. We're at the beginning of it, I would say. So these stocks have a long way to go. So I'm positioning myself like because I think that these are going to be some great things to yeah. Hey, Rick Fool is hey, I hope Rick don't get mad at me, man. For your name on this channel, man. But no, yeah, Southwestern Energy, yeah. It's it's been a long time since you heard that one. So actually, it's kind of interesting. So first, Lynn Alden mentioned Southwestern Energy on one of her newsletters. It was a little while back, like a year back. She said it was on her watch list, so it was on my watch list. So I was like, okay, Lynn Alden's watching it. Let me see what it do. So then I'm at the Rick Rule Symposium, not Rick Fool, Rick Rule, right? So I'm at the Rule Symposium, and I'm having dinner with Scott Melby and some shareholders of Uranium Energy Corp and Uranium Royalty. And one of the guys there, he's on the board that manages, I think it was $2 billion. They have a $2 billion hedge fund. And he's like in disagreement with a lot of the guys on the board. And he's like, we need to be we need to have more allocated to energy. And so I asked him, I said, what companies are you looking at? And then he writes them down. He writes down Southwestern Energy Corp, right? Energy company. So SWN. And then he writes down another one, which was RRI, which I haven't looked much into that, but I do own Southwestern. So I was like, okay, you got some big hitters here, big heavy hitters that have mentioned this company, and they have been beaten up for a long time. And so I think that they can absolutely run. And I do want to do a deeper analysis on them. But right now I am holding them for more speculation purposes. But I am going to do a deeper analysis on them at some point. So yeah, that's one of them, right? It's another one. Vital Energy. Josh Young talks about Vital Energy quite a bit. If you subscribe to Bison Interests, he does a lot of articles on them. So Vital's been getting beat up. I think they diluted some shares. I think I was maybe. I mean, the oil price did shoot up really high. Because sometimes you see these charts where you'll see a stock at like $1 million, and then now it's at $1. The stock wasn't at $1 million before. They diluted a lot of shares, and now they're at $1. So, but Vital Energy can straight rip, So like these stocks have been getting beaten up for a long time, and we need investment into them. We're seeing like, OPEC cutting production, all these different things, right? This is another one. This is a financial advice. This is from my good buddy Benjamin. And so for me, this is speculation play, but I'm gonna do deeper research on it. But as you can see, I mean, during the .com, I mean, it's running at $44. It's offshore. They do offshore drilling for oil, and then you see this huge run up. 2007, they all running up around the same time. 2007, 2008, $150. So these are the cheap companies. These are the stocks that are cheap that we should be really looking into, considering, right? I'm buying, I mean, but you may want to consider, because everything else is like way overvalued, right? Right. So I can type in, many different companies here, and just see where they valued at, right? Let's see what Meta's value at. I was buying Meta at like freaking $99. I don't know why I sold it. But it may be a time where they come down to that point again. So especially if we have recession. But yeah, I was buying them down here. I should have rolled them up. Y'all, I'm kicking myself for that one, y'all. But yeah, their PE ratio 36.53. It's pretty high. Let me just look at Tesla. Right. These are the ones that are running. The Magnificent Seven, 77.02. These stocks are expensive. These stocks are expensive. They are not good values. Let's look at Amazon, see where Amazon's at. $115.17, right? So you got to buy what's cheap. Many people are chasing after these stocks, and these stocks are not good values. I'm sorry to break the bad news, but you got to invest in hated assets. You got to be fearful when others are greedy, right? So if other people are greedy, piling into these at these high valuations, and these companies aren't even, their assets don't even live up to the value that the earnings that they're getting, right? And the price of the stock, so you got to really assess it, like, hey, this is too expensive, let me go where it's cheap, which I gave you multiple energy stocks that I'm invested in, not financial advice, that I'm looking at, so this is a very important. So this is a cool article that came out. I wanted to read it with you all. Tech hungry investors are underestimating energy. We who track markets for a living tend to focus a lot of attention on the noisiest, the busiest, Tesla, anything, Apple product release, AI, whatever. So it's good to take a step back and sometimes find the stuff that's happening without getting as much notice. Energy stocks have been the stealth winner this quarter. In this month, the group has topped the S&P 500 since the end of June, climbing 13%, and then again since the end of August with a 4% gain. Of course, the rebound in crude oil is part of the impetus for the outperformance. WTI has gained more than 25% this quarter, spurred in part by Saudi Arabia's production cut extensions. But gains in the underlying commodity haven't been the only reason behind the rally. So we are in the very early stages of an earnings revision recovery in the energy space, she said. We're starting to see energy do what tech was doing at the beginning of the year, exiting that downward revision cycle. In addition to that recovery, which she said that is still in its early stages, valuations for energy stocks look attractive, right? We talked about the value, the PE ratios and stuff. We talked about valuations, right? She's saying that it looks attractive versus the stocks that are expensive that everyone's running after don't look attractive. So you gotta weigh those out. That's especially true when they are contrasted with tech, which looks overstretched and overvalued. All right, so who's saying this, right? So this is Lori Vasina, RBC Capital Markets, head of U.S. equity strategy. So it sounds like she got an important job, right? Um, she got an important job, and she's saying that the tech sector is overvalued, and she's saying these energy stock valuations look attractive. So you got to follow. At some point, you do have to like look at what is big money saying. What are the changes in the trends? Things of that nature. I mean, because like me, I'm always keeping my mind open, my eyes open. So, for example, when I was at the dinner with Scott Melby and them, and the guy that I was talking to that pointed out Southwestern, and he pointed out RRI as well. Let's see, I'm gonna look that one up too. No, not RRI. I'm tripping. Let me see. I know I got that. I know I got that sheet. It's like a piece of paper he gave me. I'm gonna have to find it. RRI is Riverside Resources. That's from John Mark Stouty, who I interviewed on the channel. He actually he's the CEO of RRI, which I'm a shareholder of them too. But I was talking about a different company. So let me find it. I got it right here in a shoebox. It's in a shoebox. You got to keep valuable information, y'all. It may be your payday off, right? So have it in the shoebox. Here we go. Uranium Royalty, UEC. All right. So he told me it was RRC stock. That's what it was. I messed up on it. My bad, y'all. He gave me another one on here. I may or may not give it to y'all, but I may have to just go collect that for myself. So he sent me this stock here. It's called Range Resources Corp. I have not researched into them or anything like that, right? But yeah, it's a natural gas exploration company. So he sent me another nat gas company. I don't know how long they've been in, but I mean, you see, shoot, 2008, 2007 and 8, what they do, they ran right here. I mean, they were in the value sector. Everyone was buying tech. This stock was at $1.38, ran up 69 bucks, came down, ran back up to 86, 88 bucks. So these are the cheap stocks. These are some of the cheap stocks. I mean, look at the PE ratio, 4.78. 4.78. So yeah, you gotta buy what's cheap, y'all. I gotta see this really quick, y'all. I just had to see this. Let me see something. Okay, never mind. I was about to have not a heart attack. I don't want to say that because I actually had a heart attack before, but I was about to be shocked because I remember I had got a free shares of Chesapeake Energy from Robinhood, and they were like at $1 or $2 or something, like back in 2017, 2018, something like that. But yeah, that's not the same. So anyway, so we see that energy is cheap. I mean, I've pounded that point home multiple times, right? So I'm just going to read a little bit more of this article. It says the leadership stocks are tired and need to take a break. Money is going to rotate into these value-oriented sectors, and I think energy is giving you one of the best alternatives. There are other strategists, including Oppenheimer, John, who agree, especially given continued inflation concerns, right? People are waking up. People are keeping their eye on this. So you're still early. You're not, you're not very early. Early would have been like 2020, where you could have got these stocks at pennies on the dollar. I wish I would have held on to some of them at the value I got them at, but I didn't. But I've been back in and everything. So they're going to go a lot higher. So it says, but on the flip side, the investors don't see it. They don't see it because they're blind by mainstream financial media. People are tuning into the Jim Cramers, the CNBCs, these cookie cutter mainstream financial medias, and they're not seeing the opportunity or the value. Warren Buffett has been buying oil stocks. He continues to buy Occidental Petroleum. So you have to ask yourself, why is big money looking at the resource stocks, but everyone else is still looking at these tech stocks? He's saying investors don't see it or are still hoping to squeeze a few more drops of growth out of tech. According to Bank of America's latest fund flow survey, the bank's clients haven't been putting their money into energy stocks. Yeah, I know, right? I know there hasn't been much investment into energy stocks, which is why, or into energy in general, which is why we're having supply shocks and we're having issues with inflation ticking back up. We're not bringing more supply on. It says in energy stocks, along with industrials and utilities, have seen outflows this year, even over the past month, as actual energy pricing has climbed. Tech remains the shiny object this year, with the trebling in Nvidia shares and returns of around 40% for communication services and IT. But with that performance wavering as of late, some investors are looking elsewhere. All right. So at some point, people are going to turn their attention to the energy stocks, and you can either be positioned for the runs up. Right now they're already running up, but you can be even further positioned, or you can be left behind. That's totally up to you. I'm just giving the knowledge out there so that you all can think, act, and prosper, right? So that's why I want to provide this information to you all. So also just want to share, if you are a precious metal bug like me, I am a affiliate with Miles Franklin. If you purchase through them, your purchase through them supports this channel. So how you can reach them is you can email them at info@milesfranklin.com or call 952-929-7006. Tell them that Daryl Thomas or the Money Level Show sent you, and I'll receive credit. So they sell platinum, palladium. They actually got some deals up right now that I'm actually going to share with you all. I got to pull it up in my email address. They got some deals on some precious metals right now. So let's look at them really quick. Boom, boom. All right. So this is one deal here they have. So hop on this before the end of the week. It may sell out. So they have a silver bars bundle, 5 5-ounce bars and 5 10-ounce bars, just $1.89 over spot. So it's good, fair pricing, right? They also have some other deals that are happening right now with they have 1/10 gold eagles, 37 over spot, silver choice rounds, 250 over spot an ounce. So be sure to check them out and everything. And yeah, because you get some good deals and you can support the channel by doing so. So, all right. Well, I hope you all are doing well and everything. Y'all take care. I'm going to go ahead and I need to get some rest. If you missed the show, I'm logging off, but you can rewind it and watch it again. So, yep. All right, y'all. Y'all have a good night. Peace.